Greg, we'd love. So you can go ahead, Greg. I would love for you to introduce yourself and then we can get started.
Sure. Hi. Thank you. Thanks for that. Hi, everyone. So, yeah, my full name is Love Gregory, but you can call me Greg. Can I share my screen? It says it's disabled.
Let me make sure.
How's everyone feeling today? Maybe on a scale of 1 to 5, 5 being, high energy. I'm a night person. And then, 1, I'm kind of flagging already and, just ready for the day to end. Maybe you can just put it on the chat, just to get a sense of where you are energy wise. 4, great. Thanks, Raquel. Okay, 2 4s, Regine. While I'm sharing my screen, we'll wait for the other responses. Okay. Oh, 4 with an exclamation point. Thank you, Franz. And Lance. All 4s. Great. Anyone else hasn't replied? A couple, Floor, Kenneth, but anyway, just feel free to put in the chat when you're ready. So yeah, hi. So today's session, we're going to talk about empowering you guys, entrepreneurs, for decision making. And as mentioned, this is really more around operations. What do we look at, and financials. I know you've had a session on financials already. Maybe it was more around fundraising. So this one is more around ratio. So if this is familiar, let me know. This can be just a refresher. If not, happy to dive into this with you. So quick introduction about myself. I have been in Impact for the last 15 years. So my first job was as in the impact space, was in direct service with Urban Poor, the Urban Poorest of the Poor in Paco and Pandacan, with an NGO called FCED, Families and Children for Empowerment and Development. And then I was executive director of a social enterprise, Gifts and Graces Fair Trade Foundation, which I ran for about 8 years. And now I'm a director at Exchange. And I'll talk a bit more about Exchange in the next couple of slides. I'm also co-lead with Impact Pioneers Network. We'll talk about what that is as well later, as part of my introduction. I was an Asia Society Philippines Young Leaders Fellow in 2007. I have an MBA from IE Business School and Brown University. I am part of the board of advisors of De La Salle University, the Ramon V. Del Rosario College of Business. And I haven't quite started it, but working on my own startup. I am the founder of Armore Collective. It's a conscious fashion business. So welcome, everyone. So really quickly, just to introduce Exchange and for further context on my background, basically Exchange is an impact investor. We provide capital to different social enterprises, and who are addressing different issues that are part of our global checklist in education, climate change, in health. And our approach is to invest in enterprises, providing both the financial support in the form of capital, equity, convertible debt, and providing non-financial support. So we have a lot of experience working very closely with the enterprises that we invest in, working at the governance level, strategy, hiring, accounting, finance, operations. And basically, because the enterprises we work with are very early or quite early stage with traction already, we have a lot of experience in helping them overcome the valley of death and improve their operations and their financials so that they can get follow-on funding. So just really quickly, as I mentioned, we provide light touch support to other incubators. We participate as judges and mentors. Our core work is really the investment and incubation piece. And we have set up together with Vilgrow Philippines a joint venture, the first Impact Angel Network in the Philippines, Impact Pioneers Network. Uh, there. And so just to give you an idea of some of our partners, right now we have an incubation program with WWF under the Plastic Smart Cities, incubating for enterprises who are experimenting or piloting solutions to address plastic pollution leakage. And as part of our portfolio, we have Bagosphere and a couple of others that you might be more familiar with. Happy Noi was our first investment. Rags to Riches Bayani Brew. So that's me. I want to pause here and, just to get a sense of who are here and what you're doing, I would love for you to just briefly introduce yourselves. What's your name? What's your enterprise? What problem are you solving? Not necessarily an impact problem, but even if you are not an impact enterprise, you are providing a product or service that is addressing a pain point or is providing a gain to your target market. And why are you excited by the work that you do? Essentially, why did you start this work? Why are you doing it? And what do you want to learn today? So maybe I'll stop sharing quickly and maybe we can just go around the room. Who wants to go first? Or maybe I can just call. Yeah. Do you think I should just call or you want to help me call?
I
Vol-
can help, but for those who are unable to speak or maybe don't feel comfortable to speak, you can also share it in the chat, and I'll
yeah.
quickly place the question so that you can also have it as reference.
No one wants to go first. Just a brief intro. Yeah. So it's in the chat. What's your name? What's your enterprise? What problem you're solving? And just quickly, why are you excited about the work that you do? And if you want to share, what you want to learn today. Is there anything pressing or something urgent, burning questions? And we'll see if, somehow we can cover it. Um,
Hi, good evening to everyone in the room. I just my internet's just weak right now, but I'm Regine. I am actually joining from the Payoneer side, and we are co-organizing this workshop series with the Bridge for Billions team. So I don't actually have an enterprise, but I'm excited to learn more about how early stage entrepreneurs or those small businesses or those who are still thinking of starting their businesses, how we can help them grow.
great. Thanks. Thanks, Regine. Anyone else want to say a few words about, why are you here? Okay, Franz. Hi. Um, Graduated MIS, worked for Dash Labs, data scientist. Cool. Okay, working on Supafias. Am I pronouncing that correctly? Helping content creators and their communities earn by creating marketplaces for their niches. Nice. Okay. Why is that exciting for you, Franz?
Hello.
And you can also put it in the chat. Oh yeah, sure. Please
Hi.
feel free to unmute. Hi.
Yeah. So with my previous work, we actually worked a lot with content creators, and I found that a lot of people um around me are actually getting more or like exploring the path of content creation even as early as like graduation. So it's interesting that like not a lot of people are actually building for them. So it's a space that has got me excited like ever since a year ago. So I decided to like take the leap, and then now we partnered up with a content creator for sneakers and then going from there. Yeah.
Great. So you're seeing a lot of opportunity in the space and wanting to support content creators. Thank you. Um, Katya, yeah, your mic isn't working. Just feel free to put it in the chat. And as we go along, maybe, as you get more comfortable, just feel free to put in the chat. What I wanted to do is just get a sense of what your enterprises are. And so maybe we can tailor some of our discussion today. But in any case, just feel free to ask me if you have a question as I'm speaking. We don't have to wait until the end of the session. Okay, so today, what are our learning objectives? We will talk about learning about decoding financial statements. So one of the things that we're observing in the startups with many entrepreneurs is that the financial statements when you're starting out, they don't come out on time. The entrepreneurs aren't really driving this process, and mostly they think about it in terms of compliance. We need to we need to file with the BIR, we need to report our revenue, we need to pay our taxes, etc. But really, our financial statements, your financial statements, are a great source of. I'm gonna turn off my video. Are a great source of information that will help you with decision making. After that, we're going to take a look at analyzing drivers of the business using a fishbone diagram. This is a framework that I like to use because it breaks down the financial statements in a visual way. And then we will connect financial analysis with operations. So now that we have the financial statements and we kind of have figured out the stories, what are we going to do with that? And that's the link to operations. And then we want to construct the dashboard, so that we're monitoring progress as we go along. Great. So Katya, hi, senior HR manager, excited and want to explore business since your husband. Sorry. You and your husband just started a small business, which is a physical therapy clinic. Great. Raquel, hi. A person with disability, a founder of RS Technologies, social impact for PWD Health, by providing them a platform for connections and learning curve for PWD Health. Great, great. A lot of opportunity in both PT and for PWDs as well. I think there's definitely a growing awareness on gender, diversity, inclusivity, and of course that includes PWDs, and making our built environment and other process and other businesses more inclusive, right? Jael, is that the right way to pronounce it? Jael Cortez, woman leader with disability from TERPCAP. We bridge the deaf community to businesses, championing accessible communication for all. I have a deaf brother and a husband who is hard of hearing. So what I do is really personal advocacy. Great. That's really important because when entrepreneurship is tough, I'm sure you're already starting to feel that, and being very clear on your why and what you're doing, why are you doing this, and the problem that you're trying to solve, having that front and center and why you're doing it is very important. Yeah, great. Thanks for these answers. Okay, yes, already a collab here. Potential collab. Yeah, absolutely. We should all work together and find synergies, right? And if I don't remember later, maybe offline, we are also working with Ashoka, Philippines, and one of the fellows is working with the deaf community. And maybe we can talk about that some more later. Okay, great. So given those 4 learning objectives, what we'll cover will more specifically, number 1, decoding financial statements. Number 2, using a fishbone diagram to analyze drivers of the business. And number 3, setting up a dashboard. So I've organized today's presentation into those 3 things. Okay, so for decoding financial statements, as entrepreneurs, we have many questions. Are we going to make payroll this month? Is the business growing? We have sales, but I don't know where the money is. And so I don't know if you want to share, but maybe internally you can also kind of reflect what keeps you up at night as entrepreneurs. And specifically, what questions do you want your financial statements to answer? If you want to unmute, feel free to do so. If you just want to share in the chat. I know this is kind of can be a bit private, so no need to share, but this is something to reflect on. So yeah, Flor, just quickly, Flor Tagulaw, hi. Planning first business, more on online like TikTok. Sister PWD, I'm living here together with her family. Great, great. I think now is a great time to start a business. Macroeconomics aside, there's never a perfect time. And like now I'm also, working on taking that leap. And what I've heard from other entrepreneurs, they always say, I wish I had done it sooner. So congratulations if you're just starting or if you're already in the thick of it. Congrats to everyone everyone here is already doing it. Okay, so going back, basically we have some challenges, or we may face some challenges in the future. There are questions that we need answering. Growth seems to have plateaued. Sales are the same as last quarter, or I was higher if you're doing like a quarter on quarter or a year on year. I was higher in my sales were higher in July of last year than July of this year. I wonder what's going on. Or my sales are higher this year than last year. And you want to analyze what you did right? And so, or is the business cash strapped? Or if you are starting a new channel, you want to get into retail, or you're on TikTok, you're on Lazada, you're on Shopee. I know TikTok has now started a shop. You want to know, is the channel profitable? If you're changing price, you want to see, was there an impact? Did my sales lower because I increased my price? If you want to expand and are looking at taking out a loan, and you want to know, will I have enough money to be able to pay for the loan? We don't want to take out a loan and find out that we won't actually be able to pay for it. Or what is the impact of a new hire? These questions can be answered by our financial statements. We won't go into each of these. And what we always tell our entrepreneurs, we don't expect you to become accountants or bookkeepers, right? It's not about you knowing how to bookkeep or how to post, or how to post your financial transactions, but you have to have at least a basic understanding of how operational events, let's say sales, or purchasing equipment, or making a new hire, where does it show up in your financial statements? How does it impact your financial statements? So that you can have a conversation with your accountant or your bookkeeper, and you can ask the right questions. A lot of times we're seeing that entrepreneurs are, when we ask them questions, they'll say, oh, I don't know, let me ask my bookkeeper. Or they're not familiar. And while, yes, we want to outsource some of these things, right, because we want to kind of free up our bandwidth, we have to have at least a basic knowledge of how financial statements work. So get just a quick, I guess, scan of the room. Is everyone familiar with the three basic financial statements? Your profit and loss, your balance sheet, and your cash flow statement. Maybe yes or no in the chat. If you've heard of it, if you're familiar, if know how to actually read it. If not, it's okay. No worries. We'll go through it quickly today. And hopefully it whets your appetite to learn more, because we can only cover so much in an hour and a half, right? So basically, financial indicators will tell managers where to dig deeper. For example, if sales are not increasing, you're looking at your revenue line, it's not increasing, then you can dig deeper on the non-financial side. How many customers do you have? Do you have repeat customers? Are you losing customers? Are basket sizes shrinking? Is this distribution channel not performing as well as expected? Or if you're online, is there a lot of traffic but a lot of abandoned carts? So just looking at the financial statements will point you in the right direction towards analysis and then action. And we'll get to that a bit more later. So basically, there are 4 basic ways to find the stories that financial statements are telling you. Okay, great. Raquel, your aunt is a CPA and your mom is a bookkeeper. So that is definitely an advantage as an entrepreneur, right? Being comfortable with financials. So 4 ways. 1, you look at the current period. So if you're looking at this month, or you're looking at a quarter, or if you're looking at an annual, you look at all 3 financial statements. And what we like to do is kind of do it as an expression of one line item. It's called the common size. So basically, let's say you have your revenue, right? You have your sales, your cost of goods sold, or your cost of sales. And then you have your gross profit. And then you have all your expenses, let's say marketing, your overhead, your rent, etc. And then you have your bottom line net income, right? So what we like to do in order for the numbers to mean something more is we like to look at the ratios in terms of what is it what is the percentage against sales. So let's say marketing. If you've spent, for example, 10,000 pesos for this month, just to make the math easier for me, on sales of 100,000, then you've spent 10%. Marketing is 10% of sales. And so that's a good way to do it, to express everything as a percent of sales as far as a profit and loss statement goes, because it will show you the relative weights of your expenses. And then if you're looking at your gross margin, say, so let's say your revenue is again 100,000, right? And your cost of goods sold is 50,000. So your gross profit is 50%. And so that is an indicator of the health of your margins, and you can benchmark against other similar industries, and you can other companies in the same industry or with the same business model, and that will give you an idea. Is 50% high? Is it low? Are other companies actually making a higher margin? Are they at 70%? um or 50% is pretty healthy given the kind of business model. So basically you look at the period and you make an analysis. You find the stories from the period that you're looking at. The second one is using ratios and key metrics, and we're going to spend a little more time on this later. And so the gross profit margin is an example of that. And so for this, you're combining information from the profit and loss statement, balance sheet, and cash flow statement, so that you can better understand what's happening with your business. And as I said, we'll talk about this more later, so I won't get into it now. The third one is looking at multiple periods. So that's also called horizontal analysis, where you're comparing horizontal historical data over multiple periods. It can be, let's say, quarter one 2024 versus quarter two 2024. It can be quarter one 2023 versus quarter one 2024. It can be month on month. And so basically what you want to do is to look at separate periods and see, is there a trend? Is there a certain pattern? Maybe you will find a pattern around seasonality. So mostly a lot of the business, they have, the peak season is in Christmas. And coming from your analysis, you can figure out, okay, August, I was this much. By the time I get to September, I know that sales will increase by times 1.5. By the time I get to November, it increases by times 2, by 100%, right? So by doing horizontal analysis, you can kind of figure out, okay, by the time we get to February, people don't have as much money to spend anymore if you have a consumer product. And so we're expecting sales to dip. And so understanding how your financials or your revenue, your profit and loss, what that looks like over time, over different periods, can also help you with financial projection. So I know you had a session already on fundraising, and among other things, the funders will look at historical data, but they will also look at your projections. Where is this going? Where do you expect to be? What will it look like in 12 months, in 24 months? And then lastly, you want to check against budget. If you had intended to spend only, say, 50,000 on manpower, and then you find that you had actually spent 70,000, then that can also be an indicator. If it's more than 10%, then you want to check the variances or the deviations, right? Then you want to see, okay, what happened here? How come I spent more? Or how come I spent less? And part of the budget includes sales, right? If you are budgeting sales of 100,000, but you only hit 80,000, then you also want to investigate that, right? So essentially, looking at the financial statements can already tell you in general what's the overall health of your business, right? And so diving deeper into ratios, which is the second way to draw out the stories from financial statements. Is anyone here, Raquel, with your mom being a CPA, are you more or less familiar with ratios? And for the others in the room, is this something already familiar or not so much? Maybe yes. Okay, great. Maybe a 1 for familiar and 2 not so familiar in the chat. Would just love to see, where we are, where the group is overall. So, okay. So please feel free, just put a 1 in the chat if you're familiar, 2 not so familiar. Thanks, Ariel. Okay, so financial ratios measure the relationship between accounts in a financial statement, right? They're used to assess the enterprise's overall financial health and value and allow for a deeper analysis. And with the ratios, you can also compare enterprise performance with other enterprises in the industry. And so we'll talk about 3 types of financial ratios today, with a caveat that, not all ratios are relevant for your enterprise. First, you need to determine the business questions that you want answered. As I said earlier, right, there are several questions that we're asking. Where is the money? How fast am I moving my inventory? Am I profitable? Then coming from the business questions that you need to answer, then you can figure out the financial ratios that that you need to be monitoring. So a couple of 2s, a couple of gel is 1, and then a couple of 2. So just feel free to raise your hand or ask questions if you have any questions in this next section. Okay, so first off, efficiency ratios. We have, I have a couple of examples here. This is not exhaustive, but just wanted to give you a flavor of what this looks like. So efficiency ratios measure how well a company sorry for the typo, is utilizing its assets and resources. So if you have your balance sheet, right, you have your assets. On the asset side, you have your cash, you have your inventory, you have your accounts receivable, you have a couple of other things that, but those are basic 3 main assets, right? And so coming from those assets that we start with when we start a business, we start with an initial capital, right? So maybe we put in 100,000, 300,000, 500,000. And with that initial money, 500,000, we can buy stocks. We can, we can buy stocks, and then as we get sales, and then if we were able to get a sale, but we haven't been paid yet, then that becomes an accounts receivable. But essentially, everything in the asset side are things that we can use to generate revenue. So the first ratio I have here, the asset turnover ratio, you can get that by taking the net sales, which you can find in the profit and loss statement, and divide that by the average total assets, which you can find in the balance sheet. And what that does is that measures a company's ability to generate sales from assets. So what does it mean? So let's say you have 100,000 in assets, and you were able to generate sales of 200,000. So that means your assets of 100,000, sorry, is working very efficiently because you were able to convert it to sales of 200,000, right? So it's a red flag if it's a ratio of less than 1, because that means that the assets are not generating enough revenue and are not working very efficiently. So if you have 200,000, but your net sales is 100,000, then definitely that is something that you should be looking at and saying, okay, what's happening here, right? Another key ratio for a business with physical inventory is the inventory turnover ratio, where you take your cost of goods sold divided by average inventory. So cost of goods sold, you can find that also in the profit and loss statement. And average inventory, you can find that again in the balance sheet. What does it tell you? So I don't know how familiar you are. Basically, when you have revenue, if it's 100,000, there is a certain cost for you to be able to produce the product or service that you sold to your customer, right? And so the cost that you incurred in order to produce that product, if you're trading, you bought, for example, you bought from a community in Baguio, you bought a product for 1,000 pesos, and then you sold it for 2,000 pesos. Once the product gets sold, then your 1,000 pesos is your cost of goods sold. And your average inventory is just basically how much how much inventory you had on average for the period that you're measuring. So I won't go into details, but suffice it to say that the inventory turnover ratio is important because it measures the number of times a company's inventory is sold and replaced during the period. So let's say for 1 year. For 1 year, let's say you had inventory of um in for this year, let's say in month 1, you had inventory of 50,000. And then by the end of the year, you were able to sell that inventory and converted it into sales of 100,000, right? So that means you were able to turn your inventory once for the entire year. And that is a measure of efficiency because that tells you how quickly you're able to move your inventory. If it's moving very slowly, then there is an efficiency problem there. And so you can also see that if you turn your inventory more than once, that you will have greater net gross profit. What does it mean? So let's say you had 100,000 in sales, less 50,000 cost of goods sold. That means your gross profit is 50,000, right? So if you sell it only one time, then 50,000 lang yung kita, right? But if you sell it twice, let's say by month 6 you were able to move the entire 50,000, and then by month 12 you moved it again. So now your inventory turnover is 2. And instead of making only 50,000 from your inventory, now you've made 100,000 because you made 50,000 the first 6 months. You made gross, you made another 50,000 the next 6 months. So the faster you turn your inventory, the better for you. So Raquel, if services, ano pwedeng inventory doon? So not so, what do you call it? Not so applicable if you don't have a physical inventory. But what you can do is if you have kind of a product, you've productized it, right? So meron kasing there are services that you, and is it okay if I'm switching from Filipino to English? Just let me know in the chat. But if you have a product, a service that you're highly customizing, let's say you're doing it B2B, right? And then B2B client will say, "Oh, I want this." Let's say it's an HR service. I want this, but not this. And there's a menu of services. So each time you are incurring a different cost, right? In order to customize it, you're hiring people. If you're teaching a class, then you're hiring teachers, curriculum developers. If you're hiring, again, providing a service, if you're like a consultancy service, for example, or a bookkeeping service. If you have a bookkeeping service, then you have to hire your bookkeeper, right? What you can do if it's a service is you're already productizing it. So for bookkeeping, let's say our standard product is 40,000 a month and you get these several inclusions, right? So your cost of sales there will be the cost of your manpower, right? That you've hired for this purpose. And so you can still look at your average cost in terms of the manpower that you have and the number of clients that you have or the revenue that you have. So it would be a different ratio, and I can get back to you on that. But essentially, for efficiency, you will already know, is the are the people that you hired, let's say again the bookkeepers, no, if they're only working on one client, but their own capacity is, because you're not going to work full time for one client, their own capacity is they can take on 3 clients at a time or 2 clients at a time, then you know that there is an inefficiency there and you're kind of at overcapacity, you have some excess capacity. Then you know that you can still go out and hire, you can still go out and acquire 2 new clients without sacrificing the quality or the service levels for your for the clients that you get. So you need to calibrate what's the right service hours, what's the service levels, etc., for the costs that you have. Okay, and receivables turnover. So as mentioned, accounts receivable, that is also an asset that sits in your balance sheet. And so if you're starting and client will say it's B2B, oh, can you give us credit of 30 days or can we pay you in 60 days or 90 days? Then you want to see how many times are you able to turn your receivables into cash. So while receivables are an asset, yes, cash is king, and definitely you don't want your accounts receivable to be very long, because that's money that you're not able to funnel back into your business. So you want to know, are we being efficient about the receivables that we have in the balance sheet? So how many times are you turning your receivables? But if you're able to get clients that don't have a credit line yet with you, and accounts receivable are zero or minimal, that's still a better option. But if you find that in order to penetrate the market, you need to give some terms, maybe 15 days, 30 days, that's okay too. But normally, for first-time clients, you want to test them out a bit, have them pay in cash first upfront, or I mean, pay on um, when you deliver the service rather than giving a credit line. And once they've established history with you, then maybe if they're a good payer and you have regular business with them monthly or quarterly, then maybe you can start thinking about extending credit to them. So yeah, basically efficiency ratios, as I mentioned earlier, measure how well a company is utilizing its assets and resources. Okay, next, profitability ratios. I'm sure this is something that is more familiar to most, if not all of you. We want to know our gross margin ratio and how much profit is made after paying cost of goods sold or cost of services. So for this, you only look at the profit and loss statement. Both of these numbers are there, your gross profit and your net sales, because again, you want to see your margins, are they healthy? And then because what is left over from sales less cost of goods sold is what you will use for your overhead, for salaries, for rent, for utilities, for marketing. And so at that point, then you look at another ratio. At the end, you can look at net income. You can also look at operating margin ratio, operating income over net sales, where you're comparing operating income, well, as the name implies, no, to net sales. So again, the health of the business, and depending on what the numbers come out, and if you are able to access kind of what's the industry standard, then you can check, okay, other businesses in the same line are actually at 10%. I'm only at 5%. So then that's an indicator for you to dig deeper, right? Where can I and sometimes it's a combination, cutting costs, but I would caution against cutting too much. There's bootstrapping, but there's also what we call maling pagtitipid, where you're already cutting to the point that you're not able to efficiently generate sales anymore. don't cut to the point that you're sacrificing your ability to generate value and to generate sales or revenue. And so most of the time, it's more of you need to increase revenue, because when you know these ratios, then you can figure out your break-even point, because there is a basic level of um, costs in your cost structure. There is a basic level that you will have, and from there you can determine your break-even point. So let's say your salary, your rent, uh, the salaries that you need to pay the people that you've hired, etc., etc. Let's say all of that is 100,000 for the month. And then with your gross margin, then you need to figure out, okay, what's my break-even point? In order for me to be able to cover all my costs, then I need to sell 200,000, I need to sell 300,000, I need to sell 400,000. Then it gives you a goal. Okay, this is what I need to do. This is the number of products I need to sell. These are the number of clients that I need to get if it's a service business, so that I can meet all my overhead. So I prefer that, because that's a growth mindset where let's grow sales so that we can cover operational costs, rather than sales is not growing, let's cut down on our costs. I'm not saying that that's not the right thing to do, because sometimes, it's really necessary, especially if you have a lot of bloat. If you have, if you're, say, paying for subscriptions that you don't need to pay for. Like an enterprise that we were working with was paying for, I'm not sure what it was. I think it was Adobe. Um, Photoshop or something, but now with Canva, is there a cheaper way to do it? And in that sense, if you're cutting out fat, that's fine. But if you're already at your minimum cost structure, in order for your business model to work, in order for you to deliver the value proposition, in order for you to maintain service levels, then you have to grow the business so that you grow revenue so that it covers costs, right? So these ratios will help you figure that out. And then return on assets, net income over total assets. It measures how efficiently, and so it's kind of both, right? And efficiency and oh, maybe this should be on the efficiency side. Maybe, sorry, I wasn't able to edit it. But basically, you want to measure how efficiently the company is using its assets to generate profit. So it's kind of both, because it is related to assets and profitability. So if you put in 500,000, you have total assets of 500,000, your net income is 300,000. Then you can generate your return on assets. There are some businesses where um the assets are low. Maybe the entrepreneur put in 100,000, and then the 200,000, the rest of the money came from debt. And so that is more of a leverage ratio that investors will also look at in terms of your financial statements. But for the purposes of this, how efficiently are you able to utilize your assets so that you're able to generate profit? So earlier it was about sales. Now it's about the bottom line, the profits. And so it's all relative, right? It measures a company's ability to generate income relative to revenue, balance sheet assets, operating costs, and equity. And then lastly, we won't get into leverage ratios, but so for this one, it's liquidity. The last one is liquidity ratio. So what that means is, do you have enough money? Are you liquid enough so that you can pay both short-term and long-term obligations? And that doesn't only mean debt. It can also mean on the liability side. If we have a customer, if we have a supplier, and this time we're the customer, right, to our supplier, and our supplier gives us a credit line of 30 days. So let's say you were able to, you bought something that you would then sell to your clients, but you don't have to pay your supplier right away, then that shows up as a liability. And then of course, if you incur debt, then that's also liability. So current assets, investors also look at this, because we want to know whether the company will be able to pay off its current liabilities. And then operating cash flow over current liabilities measures the number of times a company can pay off liabilities with the cash generated in a given period. Okay. So just briefly, this is just, again, a sample of some of the financial ratios and the information that it tells you and where to find it. As discussed, inventory turnover. It's a combination of information from the P&L and the balance sheet. Current ratio, both of these are in the balance sheet. Asset efficiency, that's balance sheet, and cash flow, operating margin, just the P&L. And another thing just to highlight before we move on from this topic, as I said, cash is king, right? So we want to understand the working capital requirements of your business. You make sure that there's always cash. So at the point where you are maybe making a purchase order for raw materials or you're hiring people, the bookkeeper, you're already incurring cash here. You're already using working capital. And then when you sell your product or service, if you have an accounts payable, then that again is working capital needed. And then once you're able to turn that into sales, you're able to harvest, you're able to collect on your accounts receivable and collection, then you're able to harvest and turn that money, right? Why is this important? Because from here, day zero, to here to the point of sales, this can be 30 days. If you're importing something, maybe that takes some time also. And from the time that you sell it to the time that you're able to collect, maybe that's another 30 days. And so before you can convert into cash, that's 60 days, right? And so sometimes that answers the question of, I had sales, but the money in the bank doesn't really reflect that. And so I would highly encourage that you take a look at this. So you have your cash conversion cycle formula, you have your days inventory outstanding, because this inventory takes away cash from your business. Sales outstanding accounts receivable takes away cash from your business. Payable outstanding, if you are delaying payment or if you have a credit line with your supplier, that extends the cash that you have in your business. So very important to know how quickly your company converts inventory and sales to cash. Okay, sorry. I think that took longer than the time allotted. But I felt that, ratios, I didn't want to breeze through it very, very quickly and wanted to give you some time to absorb. But while you're doing that, just feel free to add, put questions in the chat. But moving on, the next topic is using a fishbone diagram to analyze drivers of the business. Okay, so we know that to increase net income, we need to take a look at what's driving our costs. Net income is a function of revenue minus cost of goods sold minus expenses, right? And so we can take a look at where our costs, where efficiencies in our enterprise. Do we have the right team in place? Are they engaged? Do we have the right tools? Our team or the people that we've hired, are they less efficient because they don't have the right tools? Is there a way to decrease the cost of producing your product or service? Are you managing your cash properly? On the revenue side, there's several drivers of revenue as well. Assess the desirability of your offer. If revenues are not high enough or not growing, that's an indication of market acceptance and willingness to pay for the product or service. Or maybe it's a pipeline problem. Maybe it's an awareness problem. If not, a lot of people are entering your pipeline. If not, a lot of people are becoming aware of your business. Then you can take a look at marketing campaigns, or distribution. It can be distribution as well. Maybe this channel is more efficient. Maybe Lazada is better versus, say, if you're doing bazaars, if you're advertising on Facebook or on LinkedIn, then you can also analyze it, right? And so with the fishbone diagram, you want to break down mathematically revenue equals volume times price. Volume is driven by availability, and it can be driven by accessibility. Price can be driven by perceived value. right? And so again, these are other things that we can take a look at. If revenue is low, can we fix basket size? Or maybe it's not accessible. Maybe your products are in retail shops where your target market doesn't shop. Or if you have joined a trade fair, if it's a service, let's say you have an events marketing business, you've joined the trade fair, but your target market didn't actually go to the trade fair, then these are things that you can look at, right? And then, are you losing customers? Are you keeping customers? And so taking it mathematically and converting it into this volume times price, and then taking a look at, okay, how can I increase my volume? How can I, by increasing availability? Maybe sometimes the product is out of stock. Then if it's out of stock, then you lose sales, right? Or maybe the price is too high, or maybe the price is too low. That can be psychologically also. If it's too low, maybe customers are thinking, oh, it's too low, maybe the product is not good. Sometimes buyers have that bias, right? So again, it allows you to analyze and to decide what is the right path to take. Same for cost of goods or cost to serve. What are margins per unit? Are your raw materials too high? Or maybe your raw materials are at a good price, but logistically you're spending a lot. If it's coming from Baguio, or if it's coming from abroad, or maybe your packaging is too high. Maybe you're increasing sales, but you haven't asked for a wholesale discount, and maybe that's an opportunity for you to lower costs. So these are things that we can look at. So to give a more specific example, I've prepared kind of a mini case. Um, Nature View yogurt. It's a startup manufacturing yogurt made locally from locally sourced raw materials. And because of that, their core values, they don't want to use strong preservatives. They have a very short shelf life. And it quickly gained the following when they first entered the market, with a niche market who, like this type of product. But sales growth has stagnated. They were having some challenges kind of entering the mainstream. And so, using the fishbone diagram, Nature View Yogurt analyzed the drivers of its business to determine key initiatives to improve revenue and the overall health of the business. So what might that look like? So given the example earlier, right? Income equals revenue minus COGS minus other expenses. Revenue driven by price and volume. Volume, in the case of Nature View, they saw that they were getting a lot of returns because of the short shelf life. They saw also that they were getting out of stock in some bastion areas. So in areas where their target market, there was a high concentration of their target market. Let's say for the purpose of this, no, BGC or Makati. Maybe they went out of stock in BGC and Makati, but slow moving in other areas, let's say in the south, where they haven't really penetrated, or there's not a lot of awareness in Alabang, for example. And so looking at using the fishbone diagram, they were able to see that the low volume actually resulted from return to vendor. This is when products are near expiry. And they also saw that they lost a lot of sales opportunities. There was no volume in areas where they ran out of stock. And they also saw that the stock that they did have on the shelves of some of their distributors actually turned out to be expired products. So again, that's also related to return to vendor, the RTV, right? And then they saw that from interviews and talking with their target market, that there was not a lot of repeat purchase. On the expense side, they saw that some of the distributors, their partners, were too far away, and they had the high cost to serve. So it it turned out that, say, they were delivering to let's say, for example, Laguna, very far from where they are. Let's say they're centered in Mandaluyong, and so high cost to serve. And so the margins just didn't make sense, and they were incurring a lot of costs here, and the cost of goods sold was very high, and therefore margins were very low. They also saw that the pipeline of customers was not robust, and they could also see that their team was not very productive. And so coming from this analysis, they then determined some key initiatives. For example, in order to increase inventory turnover, so in some areas, inventory was very slow, products were not fast moving. They wanted to increase branding activity to increase perceived value and demand, so that more people would buy their product, right? So with a branding exercise, people were then, oh, this looks like a great product, highlighting on the natural ingredients, highlighting on, how it's better for their health. It then becomes a more valuable product to the target market, and therefore it will impact the volume, right? So this initiative will impact volume, which will then impact revenue. They also saw that for out of stock areas, where sales was very strong, that's a missed opportunity if you're out of stock, then they needed to review the merchandising route. And they saw that they didn't have a full-time merchandiser, and the merchandiser was maybe spending um, one third or one fourth of his time in the bastion areas and the rest of his time in the areas where there was not a lot of movement. And so, in order to get a handle on the out of stock, and just to make sure that their distributors would reorder in time so that they would always be stocked in their shelves, they added the full-time merchandiser to ensure availability. So, if the product's not available, then there's no sales. So, that's what they decided to do. For expired products, they looked at their inventory. They wanted to improve inventory control. They also wanted to increase demand, so that's related to the marketing effort. But also, they started to bundle products that were maybe more slow moving, that tended to expire as kind of buy two, take one, something like that, right? So this stimulated their thinking in how can we actually move these products or increase basket size, and maybe if they only bought one product, it's say 100 pesos. If they buy two products, then there's maybe a slight discount. Maybe instead of 200 pesos, maybe it was 180 pesos. And so slightly smaller margin, but they were able to increase basket size and move inventory. Sorry, did someone unmute? Or no question so far? Okay, so in terms of repeat purchase, customer engagement. Hi. Is there somebody speaking? No. Okay, just put it in the chat. Sorry, I think I'm I've used up a lot of time already. If distributors are too far away, then they did a channel analysis to determine the most profitable clients. What are the bastion areas? What are the high potential areas? So it may be that yes, it's very far away, but it's good to establish a foothold in that area because of high potential. Maybe they saw that, a school was going to open or a new business district was going to open, and so it made sense to stay in the area. Otherwise, if not so profitable, then they would have to figure out, okay, what do I do with this client? Pipeline of customers not robust, then they reviewed marketing spend. They started a referral program. They started to build a community so that, share recipes and things like that, right? So that they can draw more people into their community and get more people to buy the product. And the low productivity related to the merchandiser, if he has to go to 5 stores a day to check on stocks, it made more sense, for example, to provide a service vehicle, a motorcycle, rather than have the merchandiser commute and only get to two locations a day instead of 5. So by providing a service vehicle, it increased the productivity of their merchandiser. So this is one example of how to use, connect your financial statements from here into analysis, into a plan of action, right? And so I think we don't have time for this session, but it would be great for you to do that in your own businesses so that you can better understand the drivers of your business. So a few things on financial management we didn't talk about this, but if you're looking at fundraising and better financial control, make sure that you know what your unit economics are. Investors will definitely take a look at this because it's an indicator of gross profitability, and it's a reason to believe for investors, especially if you don't have traction yet. It's reason to believe that okay, margins look healthy. It looks like um, margins are reasonable and they can sell more products, and therefore it de-risks the investment. So cash is king. Number two, cash is king. Monitor cash closely and monitor the cash conversion cycle. How fast are you converting? We see a lot of entrepreneurs who, were able to sell to a corporate client 90 days later, even if the corporate client didn't have a credit line with them. They missed collecting. Accounts receivable amounts were very high. They weren't able to convert. So make sure that your accounts receivable line is not out of control. And then lastly, institute processes and controls needed for monitoring and checks and balances. And of course, how financials empower us. They're key to sustainable ventures. It helps us manage current operations. It helps us and of course investors as well assess the viability of a business model, looking at the source of revenue, the cost structure, the drivers of the enterprise. And this is where other things will come in terms of other drivers, right? Competition, policy, the PESEL analysis, political, economic, social, and technological trends. How does that impact that? And then, of course, if you're fundraising, preparing projections and understanding the types of capital needed, knowing your financials will help you with fundraising. Okay, so this is what I had mentioned earlier. On your own or with your team, create a fishbone diagram for revenue drivers and for operational levers, so that you can start, figuring out, okay, where can we improve? What do we need to do in order to improve our financials? Lastly, given that now we have a plan of action, we're going to do marketing, we're going to, improve the merchandising route, etc., etc. Then we want to set up a dashboard, right? We want to monitor whether what we're doing is working. And I like to use the car dashboard as a reference, right? This one, empty fuel, this can be related to the cash in bank. As investors, we always ask what's your burn rate, meaning your fixed costs that you will spend whether you have sales or not, and how much money do you have in the bank. So if your burn rate is 100,000 a month and you have 1 million in the bank, that means you have 10 months to keep the lights on if you don't make any sales. If you have 200,000 in the bank, you're burning 100,000 a month, then you have 2 months to keep the lights on. And so, and this one can be, related to how fast are you growing, So determine what questions need to be answered, as we discussed earlier. What metrics can lead to action? Use a combination of leading and lagging indicators, and I'll talk a bit more about that in the next slide. Ensure data is relevant and timely. If you're looking at financial statements, if already August today, and you're looking at financial statements in June, let's say your June FS only came out today, then that's probably not timely anymore, right? So you won't be able to make the right decisions. And so, as with anything, with accounting especially, garbage in, garbage out. When you create your dashboard, put the most important metrics on top, and you can check for usability of the metric regularly. Do not measure vanity metrics, meaning metrics that don't actually tell you what you need to know or answer the business questions that you need answered. And if you're not on a manual accounting system anymore, if you're on QuickBooks or NetSuite, you can also create financial dashboards using the software, this accounting software. And so quickly on leading and lagging indicators. A lagging indicator measures whether the desired result was already achieved. So revenue. We already know that revenue, once we get the report, end of month, our revenue for last month was 100,000. Then It can tell us a couple of things. Is our distribution strategy correct? Is the marketing campaign successful? But this is after the fact, right? So it's already done. We already know. Churn rate or out of stock rate, also a lagging indicator. It's something that we see at the end of a period, right? Still gives us valuable information. Is the frequency of visits sufficient? Bakit naga-out of stock pa rin? Why are we still encountering out of stock? Is the route correct? Is the frequency correct? As important are the leading indicators because it measures the likelihood that goals will be achieved and it doesn't catch us by surprise. So if we want to achieve a revenue of 100,000 a month, and that is dependent on the number of inquiries that we get, then, and if we have a website, then we need to be monitoring unique visitors. Are there new prospective clients entering the pipeline? Because if we're not getting more awareness, if we're not getting more visitors, if we're not getting more prospects, then there is a lower likelihood than that we achieve our revenue goals, right? So for unique visitors, you can also determine a goal for that. And if you are, say, a service company providing a service, again, let's, sticking with the bookkeeping example, and your closing rate is, let's say, out of 10 companies that you present to, you're able to close one deal out of 10, then it's 10%, right? And let's say the average of one deal is 50,000. Then if you want to get to 100,000, you need to close two clients. And if your rate is 10%, then you need to talk to 20 clients, right? And so as a leading indicator, if you haven't spoken or made presentations to 20 clients, then there's a likelihood that you will not meet your revenue goal. So very important to measure the outcome, but also the activities that will lead to the outcome, right? So customer acquisition cost, also a leading indicator. It can tell you whether if customer acquisition cost becomes higher, meaning you're spending more to get a new customer. It could be that maybe there's a new competitor in town. If it's lower, something is working. Maybe you are able to acquire customers from word of mouth, and you're not spending as much because it's your loyal customers who are advocating for you, right? Employee satisfaction is also a leading indicator because it indicates employee performance and productivity. So what these are will be different for each business. It depends on your business model. The important thing is, again, to go back to the questions that you need to answer and then figure out the critical path, right? To get revenue, I need to do A, B, and C. And so A, B, and C, your activities will be your guide to what are your leading indicators that you need to be measuring. If you have a salesperson, you're not doing the sales yourself. Um, uh, Again, you can ask the question, okay, this is our revenue for the month. How many people are you talking to? If you need to get more people into your website, how are you going to do that? Are you going to do ads? Are you going to join a bazaar with a foot traffic of 100,000 people a day? Are you going to a bazaar where they're high net worth individuals? And so there. So basically these are more activities on the critical path, and these are the outcomes already. But and the reason why I'm emphasizing on the leading indicators is because we don't want to be caught blindsided at the end of the month and we're surprised na, oh, how come we didn't meet our revenue goal? If mid-month, we can already look at our activities and say, okay, we are 30% away from our revenue goal, then let's push this last week. Or if you're already on week 3 of the month and you are only at 30% of your goal, well, obviously don't wait till week 3, maybe week 2, and then you can say, okay, something's not working. What do we need to do to change, right? So then it spurs you to think about what actions need to be taken. Okay, so in general, we want to set up a dashboard with the following things, your leading indicators, as mentioned, your lagging indicators. You want to take a look at key financial ratios. You want to take a look at your cash levels. How much money do you have in the bank? What is your burn rate? How much runway do you have to keep the lights on? Do you have a bloated accounts receivable? Or is this at a manageable level? Do you have too much accounts payable? Or is it a manageable level? And then of course compliance. We didn't talk about BIR or anything like that, but very important because if we miss a filing, then that also leads to penalties, open cases, etc. So make sure that you're able to monitor repertorial requirements and filing deadlines. So yeah, so basically, in your operations, we have the planning cycle, right? We start out with the goal, we come up with a plan to achieve those goals. We execute we execute on the plan. We monitor, and this is where the dashboard comes in, and then we evaluate, is it working, right? And then we reevaluate our goals. So just to emphasize the monitoring part, where the dashboard comes in, more specifically, if you're doing financial monitoring, if there's a lot of cash coming in and out on a daily basis, then you can look at your cash position daily. If you're selling something that's fast moving, maybe you're looking at the revenue daily or monthly. Monthly, if you have physical items, you can do an inventory count. Quarterly, you can look at your budget versus actual. Annual, you can look at, did you meet your financial goals? Obviously, you can also do it quarterly. You can look at metrics and milestones. You can look at standards. You can look at proper housekeeping. And so this is just kind of a fleshed out version of what maybe your dashboard will look like, and make sure that you're on top of things that need to be monitored. And then, of course, it's an iterative process, right? You start out with goals, and then plans, and then execute, and then monitor, and then evaluate. And so this is more the operational part already, right? You can start out with a goal, and the goal can be a growth goal. I want to grow the business by 50% this year, or it can be an actual revenue goal. I want to hit 2 million this year, or it can be an expansion goal. I want to enter 7-Eleven this year, or it can be a client acquisition goal. Oh, I want to get um, client corporate client A as a key client. And then planning execution. And so that's how I wanted to show how financial statements, you can use the information there. That will inform your goal setting, that will inform your planning, and then your execution, then of course, on the dashboard side, the monitoring and evaluation. And at the end of it, you take stock of where you are at the end of the year, and remember to learn from mistakes and to celebrate wins. And so I think this is my last slide. Yes. So this is I've put their project execution. This is applicable for the business overall. It can be applicable for specific projects if you're launching a new product or entering a new market. You need to make sure that it's very clear what you're doing, why you're doing it, what's the business case for it, how does it connect to your vision, mission, and objectives. Make sure that you are fully committed to it, and this is more on the operations side, right? That there's a champion, because that champion or the sponsor is critical to the success. And because what we're trying to do is new, or we're offering a new product, we're offering something that maybe people have not seen before, there's an innovation. If your project or product or service is changing the status quo, expect resistance and plan to address it at an early stage, because uncertainty is inherent, right? And we need to be agile. And if whether it's you managing the project or somebody else, then as leaders, we need to, of course, understand the technical side, but also empower our team members, because people matter more than the processes, because it's the people who implement the project. So operationally, we didn't dive into this, but I also like to talk about the culture, what kind of culture you are building, what you as entrepreneurs, if you're the founder, you are the architect of your culture. If it's a growth mindset, or if it's an acceptance of of experimentation and risks, and allowing people to experiment and not penalizing failure because you're learning something from it. It's up to you, right? But at the heart of it are the people really, and what kind of culture we want to attract. And that's the culture that you have is a key, can be a key employer value proposition, right? So we have the value proposition for the clients who are paying for our service or who are buying our products, but we also have value proposition for the people that we want to attract into our business. So failure is not always bad as long as you learn and mature and refocus. And if you're project oriented, don't work in silos, be flexible. Prioritizing projects increases the success rate of implementation. And indicators should focus on outputs, the benefits, value creation, rather than just inputs. Of course, we need to monitor this. Are we on budget? Are we, good on time? So you can do a financial budget. You can also do a time budget, but make sure that you don't lose sight of the outputs as well. Okay, so 3 minutes under 7:30. This is for homework. If you want to take a stab at designing your own dashboard based on your metrics, what are important for your enterprise. If you don't already have it, you can start thinking about it. Include financial indicators and activity indicators. So not the succeeding slides, but the previous slides. And start thinking about how will you collect the data and how frequently you will collect the data. Okay, so that's it for my presentation. I'm okay to stay on a little bit in case there are questions from the presentation, or if there's anything you want to ask me about operations, then the floor is open.
Amazing. Thank you. Thank you so much, Greg. I think we should give a couple of minutes for questions on the
Hi,
presentation
Greg.
or examples. Hi, Regine.
This is Regine.
Hi. Hi, Regine. Oh.
Yes. Thank you so much for the very informative session. It was like, to me, it was like a few MBA modules squeezed into one. I know that was a lot of information in one session, but thank you. I have one question just on financial ratios. Do you recommend any like online tools, sort of like a calculator that our attendees or any startup owners can use to just quickly do a check of the financial ratio, starting for example like a capital, and then yeah.
Yeah, I've looked at a couple. There's not one that I have recommended. There's one that I did download recently. But when I took a look at it, it was a simple Excel file. So as long as you have your financial ratios, let's say, your accountant has already submitted the report and it's in the form of Excel rather than a PDF, you can already input the formulas there yourself. So, if it's revenue, then you can just point equals revenue and then average assets, right? So because what I found, again, one being a simple Excel file, it's something that the entrepreneurs can construct according to what they need, because what I saw was it wasn't exhaustive as well. So like I mentioned, it really depends on the business model. But if you're interested to take a look, I can share that as well. But otherwise, I guess one of the key messages is it should be simple enough that even within an Excel file, you can input the ratios yourself so that it calculates automatically, especially if it's projections, right? If it's not, and you're on a software, again, if it's QuickBooks or NetSuite, it should be able to calculate automatically as long as you tell the software, this is what I want to see monthly. Again, but if it's manual Excel, um I can share that what I downloaded from another site. But again, it's something you or your accountant can construct yourself. It's pretty fun, actually. Sorry, the nerd in me. But yeah. I hope that answered your question, Regine.
Yes, that's helpful. And then I have a follow-up question just on the leading and lagging indicators. So I know that a lot of aspiring business owners would look at revenue, profitability, um as the like indicators for success. But then for leading indicators, would you recommend to look at like a few let's say 2 to 3 key leading indicators for both in the for those who are like in the retail and consumer goods industries, and then for those who are in the services industries?
Yes. So for me, the efficiency ones on the retail side, is the efficiency one is very important, the inventory turnover. Because the more you're able to turn inventory, the more efficient you are, the more profitable you are at the gross profit level. So the example I gave earlier, if you have 50,000 in assets that turns into 100,000 in sales, if you're moving that monthly, then that's 50,000 times 12. If you move that once for the entire year, that's 50,000 times 1. So for me, that's key. And then in terms of the leading indicators, that will depend on the drivers of your business. So if the entrepreneurs do the fishbone diagram, and the main driver is really moving volume, right? Let's say it's not a high margin business, but you need to make sure that you're selling a lot. Then what are the key indicators that will tell you that you will move a lot of volume for this period? And what are the key activities that you need to do to make sure that you're moving, that you're meeting the volume requirement? So it's not a one size fits all. I know the safest answer is it depends. But really, coming from that exercise of doing first the fishbone, figuring out the drivers, coming from the drivers, that will tell you, okay, this is important. I need to make sure that I'm not um I'm not dropping the ball on this particular indicator. So if we think about the sales funnel, awareness, the IDA, right? Awareness, interest, um, desire, and then action. And then we see that, yes, there are a lot of people who are interested, no problem on the awareness side. But where we have a problem is on the conversion side. Then we need to take a look at conversion related indicators. But if to begin with, there are not a lot of people who are aware and therefore not a lot of people to convert, then we need to look at awareness indicators. And awareness indicators can be number of inquiries if you're a service business. It can be the size of your pipeline. If you have 20 people in your pipeline, and if you're a service business, right, and you're calling on the same people and following up, hi ma'am, I sent you a proposal last week, just wanted to check if there's been any update, right? And you're calling the same people over and over, not adding to the number of people that you're calling, um, then that's an indicator. Rather than if you have a huge list of 50 or 100, if a client is not yet ready and say, okay, ma'am, no problem. Can I check in on you maybe next month or maybe next quarter? And then you move on to the next, right? Because in many cases, sales is a numbers game. And so yeah, it really depends on your drivers. If you're seeing that, okay, no problem with the revenue, we're seeing a lot of revenue, but where maybe we're having a lot of problems is in logistics, then you need to be monitoring your logistics costs, right? How can you be more efficient there? If it's in the raw materials, let's say you bought raw materials, and then it got to you, there were a lot of rejects, or in terms of if you're manufacturing and then there's out of 10 products that you manufacture, um let's say 2 are rejects or 3 are rejects, then you might want to improve the reject rate, right? Is it a process to improve quality? If you are buying from somebody else, let's say you're buying from a social enterprise, they're giving you products that are not good, then you have to have an agreement with them that, okay, I'm not going to buy reject products. If you're making it yourself, then you'll want to improve the reject rate, because that will impact your cost of goods sold, your yield, right? So let's say you bought a machine. The machine's supposed to yield 100 products, but it only yielded 80 or 90. Then rejection rate is too high for the same cost, right? And so again, it really depends on the business model. I hope that's helpful.
That's clear. Thank you, Greg.
Sure. To use the succeeding slides as prompt. Sorry, that's my bad. I wasn't able to edit it. It should have read previous slides. So coming from the slides before, just to, kind of jog your thinking and what should I be looking at? I can fix that before and resend to Ariel before they send it to you. And if you want specific prompts, or if you have a specific question around the prompts, feel free to let me know. Did that answer your question, Kenneth?
Yes, thank you. Wonderful. Thank you so much. Are there any other questions that we can include now? So just as Greg mentioned, I will share with you all the presentations she shared today, if that's fine with you, Greg, just so you can go over the examples, practice it, and include it. And feel free to reach out directly to me. You can respond to the email if you have any questions or if you want us to review your exercises. And then you can always get a little bit of feedback on those if needed. Wonderful. Okay. If there's no other questions, Greg, I want to say again, thank you so much for giving this very informative session. I think everyone learned a lot, and with the resources that they can use afterwards, they can continue implementing and their understanding of the ratios and the fishbone diagram. So thank you so much once again. And awesome. Hopefully looking forward to working with you again in the future with another session or something. But really, thank you so much. It was a wonderful session.
Thank you. Thank you for having me. Thank you, everyone. I know it was really fast. Hopefully, with the slides, you can just review the content and the other. I'll get you that download as well for the ratios.
Thank you,
Wonderful.
Greg. Thank you, everyone.
Thank you. And I just sent, as a quick reminder, the survey link in the chat. I sent it twice. If you could just fill it out for your attendance, it just makes it easier for us to keep track and also receive your feedback on the session. So thank you very much.
Thank you.
Perfect. Wonderful. When you're done, you can simply log off. Thank you so much. Have a wonderful evening.
Good night.
Bye-bye.